Maryland. I want to get back to these markets. And Bill Gross of Janus Capital. Bill, you were making the point that the Fed has contributed to these distortions in the marketplace. Will you go so far as to say that we are looking at a new asset bubble?
Well, no, I wouldn't go that far. I mean, PEs are relatively reasonable at 16 to 17 times. That's a historic PE ratio.
Mm-hmm.
I think, if anything,
we're heading there, though?
Not really. In some particular sectors, and as I've mentioned in China, certainly they have a bubble, and there are bubbles in Euroland bond markets because interest rates are close to 0%. So, there are bubbles around, and one of the other bubbles might be the strength of the U.S. dollar. That's gone up significantly relative to emerging market countries like Brazil and Mexico and others, and so lower interest rates and high debt levels, high leverage, tend to promote bubbles on a global basis, and so it's fair to say that there are bubbles to be found.
Let me ask you about Puerto Rico for a moment, because what surprised me about Puerto Rico all along was the appetite that we saw for it, and we did see that a number of mutual funds got into this, and it was the promise of some pretty high returns, and of course the tax break on a muni bond. But the reality is Puerto Rico wasn't like most muni bonds. It was a lot dicier, shall we say, and we're seeing that all come to fruition right now. Is this an example, Bill, of your average investor getting pushed further and further out on the risk curve because they don't have a choice? They can't make money in simple things like CDs or treasuries?
Well, I think so. And remember, though, that the Puerto Rican debt was bought by municipal bond funds and others, individuals, 3, 4, 5 years ago. So when the Fed lowered interest rates to 0%, obviously a triple tax-exempt Puerto Rican municipal bond, yielding 5 to 6% at the time, was very attractive. Now, as you mentioned, close to bankruptcy and default in some areas. And so, I think it is a good example. Let me point out, though, that there are many attractive municipal closed-end funds on the stock market, many of which I own, that are yielding 6 to 7%, and they're selling at a discount to what they call net asset value of about 10 to 15%, really attractive bargains, and the Puerto Rican situation has been factored into those prices already. So, I would suggest, if an investor wants something not totally safe, but relatively attractive with a high tax-exempt yield, that those municipal closed-end funds, a good example.
Yeah, they look at a few other things. Let me ask you, because you said something in our earlier conversation that these markets are so dependent on investment, and you're absolutely right. I want to get your thoughts on, we've been watching, of course, Hillary Clinton there live in Silver Springs, Maryland. She has proposed an increase in capital gains, essentially making it so that investors that were of higher net worth would have to hold an investment for as long as 6 years in order to get the beneficial 20% tax rate on it. Otherwise, they'd be paying a much higher rate. Bill, what would that do to the markets in your view?
I don't think at the margin it would do much. It would certainly encourage investors to hold their investments, whether it be in private equity or in public equities, a little bit longer. And the investment problem, Trish, is one in which corporations themselves, have very little opportunity, in their view, to invest money at an attractive rate of return. Most corporations, or many corporations, are buying back their own stock as opposed to putting that money into the economy. Perhaps $1 trillion worth of potential purchases by corporations, which help to elevate stock prices, but which don't go into the real economy, are taking place in 2015. So what we really need, I think what the economy really needs, is some type of incentive to get corporations to get that money out of buying their own stock.
I think you're right, but you're talking about incentives as opposed to penalties, and I think they're kind of two different things. I mean, we do have a problem, for sure, and I don't like the idea of these corporations going out and doing all these buybacks and financial engineering instead of actually really investing in the economy. So it is an issue. But finally, okay, before I let you go, because we've been talking about Donald Trump so much on this show, Bill Gross, you want to weigh in. Donald Trump, thoughts?
Weigh in on Donald Trump? No,
yeah,
I can't.
Is he making any sense to you?
Well, you know, I like Donald from the standpoint that he stands his ground. Other than that, other than standing his ground, which is very shaky in terms of logic in many areas, I don't think there's much appeal. But I think that's why he's a momentary front runner, is that the public likes him to stand up to.
He's tapping into something. I got to take a quick break. Bill Gross, a pleasure as always.